In 2019, Sri Lanka was riding a wave of growth. Tourism brought in $4.5 billion, remittances topped $8 billion, and the island seemed poised for prosperity. Yet beneath the sunny headlines, the government was quietly amassing debt to fund big-ticket projects and generous subsidies. This backdrop set the stage for a financial storm that would hit in 2022. Between 2015 and 2019, Colombo embarked on several mega-infrastructure programs: the Hambantota Port, a new international airport, and a highway network. To pay for them, the state issued sovereign bonds and took loans from China, India, and private markets, swelling external debt to about $51 billion, roughly 120% of GDP by early 2022. Then COVID-19 struck. International travel ground to a halt, and tourism revenues collapsed by more than 70% in 2020. The loss of foreign exchange meant the country could barely service its dollar-denominated debt, and reserves fell from $8 billion to under $2 billion within a year. Compounding the shock, the Rajapaksa government slashed income tax in 2019 and flooded the market with printed rupees to cover the shortfall. Fiscal deficit ballooned to over 10% of GDP, and the central bank's policy rate stayed low while inflation began to climb. By early 2022, the debt burden was unsustainable. External creditors held roughly $45 billion, while domestic banks were pressed to lend to a government that could no longer raise money abroad. Credit rating agencies downgraded Sri Lanka to junk status, warning of an imminent default. The rupee slid dramatically, from around 180 per US dollar in 2020 to more than 350 by May 2022. Imported fuel and medicine became prohibitively expensive, and inflation surged past 70%, the highest in 3 decades. Households saw grocery bills double almost overnight. Long queues became a daily sight in Colombo. People stood for hours to buy cooking gas, diesel, and rice as supermarkets ran out of stock. The shortage of foreign currency meant imports were rationed, and the government imposed emergency price controls that barely eased the pain. In March 2022, the government announced a debt restructuring plan, asking bondholders to accept a haircut, a reduction in the amount owed. Negotiations stalled, and the lack of a clear solution deepened market panic, pushing the sovereign spread to record highs. Public anger boiled over in July. Hundreds of thousands gathered in the streets, chanting for the resignation of President Gotabaya Rajapaksa and his brother, Finance Minister Basil. The protests turned violent, leading the president to flee the presidential residence and eventually step down. Facing a full-blown default, Sri Lanka turned to the International Monetary Fund. In August 2022, the IMF approved a $2.9 billion rescue package, but it came with tough conditions: fiscal consolidation, tax hikes, and restructuring of state-owned enterprises. Since the bailout, the new government has begun tightening spending, raising taxes, and seeking new foreign investment. By early 2024, reserves have modestly recovered and the rupee has steadied around 250 per dollar, though inflation remains above 50%. Sri Lanka's crisis shows how a mix of heavy borrowing, sudden external shocks, and policy missteps can quickly erode a country's financial stability. The episode underscores the importance of sustainable debt levels, diversified revenue streams, and transparent governance in protecting an economy from collapse.